So today we are going to pick up the first topic of accounting, that is profit and loss statement. So we will understand today the theoretical aspect of how to read profit and loss statement and what actually signifies the profit and loss of a company. So if we understand profit and loss statement of a company typically summarizes what is the revenue earned by the company and what are the expenses incurred by the company, finally giving us whether the company is in profit or in loss. As we all know, if the revenue exceeds the expenses, then obviously the company is in profit. And if the revenue is lesser than the expenses or the expenses turn out to be more than the revenue, then obviously the company is in loss. And this P&L or the income statement or the profit and loss statement, as we say, this is measured over a period of time. So we might have seen in various sites that the company releases the profit and loss or the quarterly results of the company. And when they share this quarterly result, it is done like on first quarter, then on the second quarter. So there you have 3 months of profit and loss, then you have 6 months of profit and loss, then you have 9 months of profit and loss, and finally you have the entire period of 1 year of profit and loss of the company. And this they do with respect to the immediate previous year as well. We can see a comparison of how the company is doing with respect to the previous year and the current year. And apart from this, the company also has a privilege of extending this profit and loss up to 15 months maximum. And upon certain approvals, it can even get an extension of 18 months before it releases the profit and loss statement of itself. So now that we have understood what is profit and loss and the time period which is involved for profit and loss, let us see what are the contents of the profit and loss. What are the composition? What are the things involved? What are the line items of profit and loss? So, as I explained earlier, the profit and loss consists first part of the statement is the revenue. So the revenue aspect is typically multiple aspects of revenue is there in terms of a company. One aspect of revenue is the core operations. So the revenue from core operation is typically what the company does day to day as part of its core activities. For example, if you take Colgate-Palmolive, its core activity is selling toothbrush, toothpaste, body gels, body soaps. So these are its core activities. So the revenue generated out of a result of selling these core products, that is called as revenue from core operations. Then the second aspect is the revenue from non-core operations. Obviously, because it's non-core, it will be those revenue which is income to the company as a result of certain investments which it might have made. It might be getting rentals, it might be getting dividends, it might be getting certain other aspect interest on certain loans it might be providing for certain subsidiaries or certain third-party organizations it might have provided. So it may be getting certain income. So all these income are going to be considered as part of non-core operation. Now that you have understood the revenue aspect of the profit and loss statement, now let us see how to analyze the expense part of the profit and loss. Now the expense portion is typically a large portion of the company. There are many line items as part of expenses, so that it makes it clear to the investor where the company is actually spending its money. So one of the core expense of the company is in purchasing the raw material, that is the cost of raw material. In order to finally produce the finished good, it needs raw materials as well. For example, to manufacture toothbrushes and toothpaste, it may need like plastic sticks, the bristles, and then it needs like paste, the tubes, the various chemicals which go into producing the paste, the calcium products, the gels, the detergents, all those aspects, there are the raw materials involved. So obviously the company which wants to produce goods, it obviously purchases the raw materials from its suppliers. So this is the expense part of purchasing the raw materials for the company. So once it purchases the raw materials, the second portion of the expense is towards advertising of its products. It may be paying certain royalties for certain trademarks or copyrights which it might be having, or it may be paying royalty to certain international organizations. For example, Colgate-Palmolive is in India is a subsidiary of the international company Colgate. So it has to pay royalties. And then certain back-end operations like, it might have like server applications for which it runs its day-to-day operation. So all these parts which are not directly involved towards manufacturing of the actual product, and may be typically fixed in nature. So those are part of selling, general and administrative expenses. Typically within the Indian context, if we see at the annual reports, all this part of the expense that is towards administration and selling, that those are typically mentioned as part of other expenses. And if you see these other expenses, a huge portion. If you compare the current year's selling and general and administrative expense, it would be typically same as the previous years. Typically for a good company which is having a strong competitive edge. So this is the second portion of the expense. The third portion of the expense is the company spending money towards labor. So employee costs, it paying salaries to people. So that is part of the employee cost. The fourth part is the finance cost. Maybe taking loans from certain organization for which it needs to pay interest. So that obviously needs to be deducted from our revenue. So that will be considered as part of our expense. So that will give us the fourth part of expense, that is finance cost. The fifth part of expense is the depreciation and amortization of the company. Now, the company will have certain equipment, certain manufacturing units or factories or certain properties which are basically long-term in nature. The useful period of these assets are typically spread across like 5 years to 10 years to even more than 10 years sometimes. So the expenses will be considered by dividing the useful life of the period. For example, if the company has purchased a property worth 1 lakh rupees this year, then the property is going to be used over a period of time, right? So this period of time could be like 10 years, after which the company might decide like I want to shift to some other location. That is why it thinks that 10 years is suitable enough to divide the expense. So this 1 lakh is divided across 10 years. So every year you come up with 10,000 rupees of expense, which is needs to be deducted from the revenue. This is the depreciation cost. The other aspect is the amortization cost. Amortization is typically for non-tangible assets and depreciation is for tangible assets. So when you say amortization, it are typically royalties, or it could be like payments or payments done towards trademarks or copyrights of the company. Certain songs or certain artwork which the company needs for selling its product. It needs to buy this from some other vendor or certain designers or certain international organization. For this, it spreads the cost of this expense over a period of time, over a period of useful life of its particular value. So we have finally seen the 5 aspects of expenses that are involved towards deducting the revenue. So now finally, after deducting all these expenses, you finally get the profit of the company. Now this profit is profit before tax. And once the taxation is applied, it will become PAT, that is a profit after tax. So looking forward to you in my next session. Please subscribe to my channel and gain subsequently from all other videos. Thank you. Bye.